Tax can be a complicated area for all businesses, regardless of size, structure and industry segment. That's why we spoke with Stephen Pincott of APC Chartered Accountants in Mansfield. A number of Alltruck customers operate within the manufacturing sector, so we asked Stephen to give us some insight and advice on tax savings that can be made by all companies, but which are especially relevant to manufacturing businesses.
Tax is a complicated area. There is a lot of regulation out there, and HMRC don't always get it right from their point of view either. And it's good for businesses to have an accountant that will work closely with them to ensure that any penalties that are levelled are correct, but largely to avoid the penalties in the first place. Also, tax is obviously a huge issue from a cash flow point of view. Businesses need to be aware of how much they're likely to pay and when, and most businesses will want to pay the minimum amount of tax possible that they can do on the profits that they're in. One area that we've identified where businesses potentially miss out on some tax savings is if they own or are buying through a mortgage some commercial premises. That can be in the form of a shop, a factory or offices. If you own or have bought the property previously, within that property there are various items that potentially you can claim for that you may not have done in the past. When you buy the property, essentially all that you'll give to your accountant is an invoice saying this is one purchase cost. It doesn't split down what else is included in there, so the accountant will not know that there are other things that can be claimed. What you can do is have somebody come in to review the commercial premises to identify any systems like heating systems, water systems, air conditioning units, lifts and escalators, and things like that that are available for capital allowances. A report is then obtained, which then can be passed on to your accountant, and your accountant can then make a claim for those allowances in your next tax return. Or if you bought the building previously, then you can actually backdate it and claim it off of your last tax return that's still open, which may mean that you get a tax refund for tax that you paid last year. There is no time limit on the claim, so if you bought a building 10-15 years ago, you can still go back and make the claim and get it claimed against your tax liability for last year. Or if you potentially are selling the building, you can put an item in the sale contract to say that you've made the claim and the future occupant cannot make the claim. So it's a one-off claim that you can make, which can give you a tax refund off your tax bill, or get a tax refund based on last year's figures. Another area where we have identified that clients can be missing out on tax allowances is if they invest in plant and machinery from a tax point of view. Plant and machinery can be anything from computer systems, diggers, or large pieces of machinery that go into your factory. If you do nothing with your plant and machinery that you have purchased, HMRC will only allow you an allowance of 18% reducing balance per year. This can mean that it takes up to 18 years to get 99% relief on the assets that you're purchasing, and to get that further 1% can take up to another 42 years. So what you can do is do a short life asset claim, where you treat each individual asset as a separate item for your tax return, and then if you dispose of that item within 8 years, at the point in which you dispose of the asset, you get full relief for the amount of loss in value you've incurred over the period of ownership. For example, if a company buys a large piece of equipment or several pieces of equipment, total cost of £1 million, and they intend to use that piece of equipment over a 5-year period and dispose of it at the end with expected disposal proceeds of £250,000, they would expect to get full relief of the £750,000 loss in value over that 5-year period. However, if you don't do a short life asset claim, you will only get that relief over the next 18 to 60 years. By doing the short life asset claim, in year 5 you will end up with full relief for that amount, and you will have paid tax, a reduction in your tax bill of £29,500. If you continue to invest in machinery year on year, so you pay £1 million for that machinery year 1, 2, 3, 4 and 5, and then you eventually dispose of them from years 5 onwards, by year 20 you will actually be £157,000 better off by the reduction in the tax bill by doing this. If you are buying an asset on contract hire, you will receive the tax relief on that contract as you pay for the contract. So if the contract is for 36 months, you will receive the payments that you make in equal instalments over that 36-month period.